The failure of a third U.S. bank in as many months was unrelated to the political impasse over the debt ceiling and is not expected to affect talks to increase the country's statutory borrowing limit. But this could change. According to analysts, the bank regulators took over First Republic Bank on May 1, making it the second-largest bank failure in American history. The loss of the San Francisco-based firm will cost the Federal Deposit Insurance Corporation, FDIC, roughly $13 billion from its deposit insurance fund, despite the fact that J.P. Morgan Chase agreed to buy almost all of First Republic's assets. The simultaneous occurrence of two financial crises, a string of bank failures, and a political impasse over the country's debt ceiling is unprecedented, but analysts say the events are unrelated and unlikely to have any bearing on weather. According to Mike Davis, founding partner of the private equity firm Olive Tree Ridge, First Republic Bank entering receivership over the weekend, and the subsequent purchase of the bank by J.P. Morgan are separate and distinct from the difficulties that is facing in negotiating options as it relates to the debt ceiling. Regarding the debt ceiling debate, Robert Kravchuk, a fellow at the National Academy of Public Administration, said this is actually a separate issue, and it is much more of a political dispute than a true economic one. However, that might alter. Interest rates may reach levels not seen in years as a result of mounting public apprehension over the possibility of a U.S. Treasury default and Federal Reserve Board anti-inflation efforts. If that were to occur, banks whose business plans have been dependent on the historically low interest rates enjoyed for the last 10 years would be at a higher danger of failing. Inefficiency and growing interest. According to Ari Rastegar, CEO of Rastegar Property, First Republic Company was management money. In this case, a bank greatly underestimated how quickly interest rates would increase. According to Rastegar, their management was focused almost exclusively around increasing deposits and not properly hedging, which refers to not reducing the risk of rate hikes like those that have taken place over the past year. The Federal Reserve Board raised its prime rate 9 times in a 12-month period starting in March 2002 in an effort to slow the rate of inflation,